In this video, guys, we're going to look at 4 useful chart patterns for bull markets or uptrends. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so 4 useful chart patterns to use when the market is trending up, or if we're in a bull market or any environment where we have that consistent drive higher or just a general pressure to the upside. Now you can use these as a long entry, which is kind of how most people traditionally look at these kind of things, or you can use them to exit a short trade. So if you've got a short, you've been in a short, all of a sudden you see this pattern, you might be like, okay, well, it's time to come out of the trade now because I've been in this short for a long period of time and now see this pattern. Now, some of these are a little bit late for that, but some of them might be like, okay, well, this is starting to form now. This would indicate potentially some pressure to the upside. I might want to start coming out of the shorts on a longer time frame. All right, so the first one I've got for you guys is the bull flag. Yes, I know that I love flags, one of my preferred chart patterns, but it's just so nice the way that it's just a real pure price action play. You know, the drive higher, there's your flagpole, which is here, there's the pole, there's your flag, and it's very easy to kind of trade these. There's no ambiguity with them. Do they work all the time? No, of course they don't, but there's always a good place to stop. There's ways to refine and adjust them, and especially when you have very, very persistent, strong markets, you see these all over the place, and they're useful on short time frames, they're useful on big time frames, and it's just something that personally I just like to scan for. So I can't do this without putting the bull flag in, guys. Number 2, support holding. So we draw resistance, we draw support levels, pretty standard stuff. But what I'd like to see is price coming up through the support, then coming back and testing it. So there's a little subtle distinction. You know, we don't want to see price coming down to support, if that makes sense. We don't really want the support here and price doing this, coming from up here. We prefer to see it coming through here, and I suppose it wouldn't really be a bull market or uptrend anyway, but we prefer to see the support forming at a high, if you like. So fresh highs, say that 20 times very quickly. Fresh highs, coming back, pulling back to the level, finding a hold point, trying again, preferably a higher high just to keep it technically good, coming down, testing again, maybe a little test again, just something to suggest that there is a buyer or a group of buyers who have stepped up, and now they're kind of not that aggressive to push it straight through highs, or maybe sellers are holding it a little bit, but they're still holding firm and happy to pick up stock, happy to pick up the futures contract or whatever it may be at a significantly higher price than it was maybe 10 days ago, whatever time frame you've got on there. So support holding, very good way of filtering out, hey, strength, and we're now seeing continued buying after strength, because what you don't want to see is strength and then just a V-shaped reversal. You want to see the strength and then test, hold, and the assumption is that the buyers then will step up and pay more and more, and this then will rotate up to here, and the sellers will back off. That's the assumption of the trade. And like all these things, guys, as well, a very nice place to quantify your risk, just under the support level. If it goes, it goes. If it doesn't, you've got a nice risk-reward ratio on the trade. At the end of the day, guys, we're not trying to complicate anything here. We're not trying to be clever. We're not trying to overthink things. We're like, hey, how can we see what's happening in the market? How can we have some clues? How can we use those clues to then come up with a trade idea? How can we express that trade idea with a reasonable and sensible stop? And that's it. That's all we're trying to do. We're not trying to pick winners effectively. We're just trying to do this in consistency. Right, third one, guys, is a breakaway gap. Obviously not that prevalent in Forex markets because the gap only at the weekend, but in stocks, if you're trading indices, yes, they're 24.5 on the futures contract. If you use the cash or use the ETF equivalent like SPY or QQQ, then you're going to get this. The same with some of the commodities as well. But the breakaway gap is really nice because it's strong, and then it's just got that gap up. So the technical aspect of the breakaway gap is, there's your closing candle, and the next candle will open up here like this, and you'll get this area here, which is the breakaway gap, and then you get continuation. So sometimes it feels a little bit like you're chasing it, but on the right conditions, especially maybe if you've broken out of a decent resistance level above that, there's a lot of people perhaps stuck on the short side looking to cover, fresh longs looking to come in. If you can preempt that, then maybe on the open of that you can have a stop below the gap level. or that's a little bit shady sometimes, because you do sometimes get a retest on the gap. So a preferable one is to wait for the close of the day to confirm that breakaway gap. So you get that candle close there and you go, right, there's the close, and then you would take a long on the close with a stop below that. So there's ways and means of doing it, or you'd wait for some strength after that. So maybe, like all these things, you can blend them together a little bit. Breakaway gap, drive with a flag, perfect. Breakaway gap, pulling back to support holding. Perhaps here was the breakaway gap. That would be nice. Breakaway up here, pushes up a little bit, runs out of steam, runs out of puff, comes down, holds, then additional drive again. That'd be quite nice. Okay, final one, guys. Number 4, I haven't written a thing on here, have I? Number 4 is the first oversold condition on an oscillator. So we're using a stochastic, using an RSI, using a CCI, anything like that. So we're seeing a drive higher, and then we're seeing the first oversold after a persistent drive higher. Really simple strategy. This very easy to screen for, very nice to trade, and then you're waiting for a resumption of the trend. So you're waiting for the oversold, then you're waiting for it to come back off oversold. So consist a long period of time where it hasn't gone into oversold and preferably been overbought, rolls back over, tagged into oversold. Now we're in kind of alert mode. As it starts to roll up, then there's a trigger potentially for the long. And then of course we can just put a stop under that recent low and manage it like that. We don't want to take it on the second or third. It's the first one really that's the most powerful. So 4 useful chart patterns, guys, for bull markets or uptrends: your bull flag, your support holding, your breakaway gap, and your first oversold. Take care, keep it as managed. I'll see you next one. Bye bye.